Welcome to the EY NextWave Private Equity Podcast, where we explore what's happening now, next, and beyond in the world of PE. Digital, sector, talent, value creation, ESG. These topics are top of mind for executives across the global private equity ecosystem. Join us for the insights you need to reframe the future of private equity. Now, here's your host, Winna Brown from EY.
Today I'm joined by two of my colleagues, Karim Anani and Alex Zuluaga. Karim is the Transactions Advisory Leader for the Americas, and along with Alex, co-leads our SPAC practice. Gentlemen, I'm really excited to have you both on the podcast today. Thank you so much for joining me.
Nice to be back on, Winna.
I know, Karim, this is your second time round.
That's right.
Very popular guy. And Alex, welcome.
Appreciate it. Thank you.
So now, guys, before we dive into the discussion, I just wanted to take a little moment to level set. Now, SPACs or blank check companies have been around for years. This is not a new concept. Yet, it's really not until the last 12 months or so that SPACs have become almost mainstream. And in 2020, almost $80 billion was raised through SPAC IPOs. And this is compared to less than $20 billion in 2019. Are you able to highlight why SPACs have suddenly become so popular? And Karim, why do you think that is?
The widespread acceptance of a SPAC as a alternative method of raising capital. It's typically primary capital going on balance sheet, but it can also be primary and secondary capital that goes towards an operating company, is an acceptable route to go today. It's acceptable because the product is probably better understood. The malleability and adaptability of the SPAC vehicle to meet the needs of an operating company and its investor group is second to none by the way of how a deal can be shaped, how you align economic interests, where you put lockup periods in place, the type of institutional investors that you can bring into a transaction. These are all very relevant factors today that Wall Street, bankers, financial institutions, private equity firms understand a lot better. That's really driving the popularity of the SPAC vehicle. I would also say coverage. As more and more blue chip companies elect to merge with SPACs and go public that route, it's in the press. People are looking at it and saying, well, if company A that could have gone through an IPO, raised capital privately, elected to go through a SPAC, let's explore that ourselves. The abundance of capital and the speed at which you can raise capital through the SPAC vehicle and through a merger is quite appealing, Winna.
From what you're saying, previously SPACs were less understood. They were used for smaller listings, but really they've become more high profile. And we're seeing, as a result, the market being more accepting and open to it.
That's right. And I would also say there's a key factor here. When a company is looking to undertake an IPO, for example, they cannot market the company on future projected earnings or revenue and the like, because that's just the way the IPO rules work. However, when it comes to a SPAC merger, because factually on a piece of paper, this is a merger, although the vast majority of SPAC transactions do not result in the SPAC taking control of an operating company, but rather making a minority investment in an operating company, it's still considered a merger. And in merger transactions, you're allowed to talk about future projections, synergies, EBITDA, growth, whatever the KPIs that matter for that particular company. And because you can talk about future projections, when you go out and you market the operating company and looking at the pre-money market valuation, you can take those future projections and bring them back in time to today and say, this is what I would like my value to be, because I know this company is going to be there 12 months, 24 months, 36 months from today. And you're taking this long jump and this leap of here's what the company is worth in 12, 24, 36 months, but I'd like to get my valuation today. And you can effectuate that and you can raise capital based on a higher valuation as a result.
So given what you've just outlined about the differences between the merger and what information you can actually present to the market, Alex, do you think that this is part and parcel why a SPAC exit is particularly interesting for PE?
Absolutely. PE is very adept at negotiating transactions. And so you've got an aspect of these SPAC mergers that is a true negotiation with another party. And then in terms of all the liquidity needs and everything that Karim mentioned before, right, you're addressing a lot of the important factors that PE are considering when they're going through a transaction. And so with the ability to either cash out a position or fund the organization and create that liquid capital in a public instrument, it's a very attractive option for PE.
And what would be some of the risks that a PE-backed company needs to contemplate if they're weighing up a traditional IPO exit versus SPAC as an exit?
The risk really is around the possibility of minimum cash not being there. And so really thinking about what mechanisms you're going to have in place in order to avoid a redemption situation where the deal doesn't go through. If you think about an IPO, there's always the risk that when you go to price, the market timing isn't right and that you're not going to move forward with that transaction. So while it's a different type of risk, it's really just based off of facts and circumstances at that point in time for the PE to see what makes the most sense for them. And that's why defining your transaction goals are very important when you're thinking about your portfolio companies.
A SPAC is a very quick transaction, being a merger, and suddenly companies find themselves being publicly listed. What are some of the challenges that you've had to help management teams work through so that they understand the journey of exiting through a SPAC and waking up the next day to be a public company as opposed to the long 6-month or 12-month journey to prepare for a traditional IPO?
Maybe I kind of take a step back here and go through what the normal mechanism was before. I mean, previously, there was a lot of inbound interest from SPACs going into operating companies. And because it was attractive, you'd have those operating companies be opportunistic and move forward those transactions. But having been put into a position where they were being opportunistic, they might not have had a true path going forward on being public as quickly as they would. And so there's a lot of rush in those type of situations. Now what we're seeing is a lot of companies, and particularly PE companies, are starting to get ahead of that and start to prepare their financial statements, start thinking about processes and improving those processes so that they have very little execution risk associated to them, so that they're in a better negotiating position when they're starting to talk to SPACs. Obviously, execution risk is very important to a SPAC because of their finite timeline.
Karim, you guys are both working with a lot of SPACs and there's a lot of success stories out there, but ultimately there are a number of SPACs that do fall apart. In your experience, how often do these SPAC deals fall apart, and how can a PE sponsor of a target company prevent this from happening?
There's different time periods in a SPAC deal life that a deal can crash and burn. Very early on, as you're negotiating an LOI and going through exclusivity, we see more deals come apart because of a difference in valuation, or you can't raise a pipe or something to that effect. Those are not announced and you don't hear about them. The more public ones is where there is a signed merger agreement and the deal is announced, and from there, for one reason or another, the deal does not consummate. The latter example here is becoming more rare. I would say less than 5%, probably less than 2% of the time. And why does that happen? It's because economics don't make sense. There's a shift in the company's profile, industry profile. It could be it's just taking way too long to get a deal done from a compliance perspective, and the committed pipe money is not willing to commit further. Or a SPAC is ending its near end of life, and you're starting to see redemptions come out of the SPAC, and people aren't willing to roll their equity for another 3 months to see that this deal come to closure. There's a variety of reasons that actually will lead to a deal falling apart. But like I said, once a deal is announced and the pipe's committed, it's not common.
Just adding into that, one thing to think on the front end is who the SPAC partner is going to be. And most SPACs will identify a target industry And so most times you want to have a SPAC that is focused on your industry because that was based off of their investment thesis. And so when you start moving away from the SPAC's investment thesis too much, you might end up having more churn on the historical SPAC investors in terms of redemptions. But as Karim mentioned, that can be mitigated through the use of pipes and backstops.
That's a really good tip. If you're looking for a SPAC, find one whose investment thesis is in your sector so they understand your business and the merger can go a lot smoother, presumably. Are there other tips that you can share for companies that are looking to attract a SPAC?
Getting your house in order and basically being something akin to IPO ready will make the company a lot more attractive for a SPAC exit, i.e. getting your financial statements and the audits done of the historical periods, ensuring they're SX compliant, making sure your auditors are undertaking what is commonly known as PCAOB audits and getting ready to render PCAOB level audit opinions on the historical financial statements. If interim financial statements are needed, getting those in order, thinking about your MD&A and drafting that, getting these compliance matters out of the way that are backward looking increases the attractiveness of a SPAC merger moving towards fruition because there's sometimes a bit of a long build in getting a company ready to undertake and file the initial Form S4 that is required with the SEC. And so if you're shortening that time period, that really can be helpful. Furthermore, building out the necessary skill set and capabilities within the company so that it can operate and behave as a public company in a short period of time is a must. It will be difficult for a company that's not prepared whatsoever to behave, act, and report its results as a public company, seeing how condensed the SPAC timeline is. And from start to finish, you can be a public company going through a SPAC merger inside of 5 or 6 months today.
So, Alex, if you were advising a PE-backed portfolio company, why would you suggest to them or recommend to them that they think about a SPAC exit over either a sale or a traditional IPO?
With a SPAC, you're able to utilize projections, as Karim had mentioned before, and kind of telling that part of the story for the organization. You're not necessarily going to be able to do that within an IPO setting, but you would be able to do that within just a normal sale transaction to another PE, to a strategic. But then it's also just thinking about what is important for that organization. What are you really trying to do in order to derive the most value for that organization? If it's truly funding the organization and you're going to end up rolling over most of your equity, then a SPAC is very compelling because you're going to be able to put all that capital that's raised through the SPAC and through the pipe and really funnel that into the organization. If you have a higher need for an exit, then there are going to be certain SPACs that aren't going to be interested in changing the ownership structure such that you exit completely. And so maybe a SPAC transaction isn't as relevant for you. But in terms of fiduciary duties and the like, it's worthwhile exploring each of the options to see what's the right fit.
And given the way the market has been so hot of late, do you think that a SPAC exit has yielded better pricing and better results for the investors?
It's difficult to say whether it's better pricing because it'd be theoretical. Most companies aren't looking at an IPO or looking at a sale exit and comparing it to a SPAC. Sometimes you might have an auction process in which you'd be able to see that. But unless you're involved in those auction processes, you're not going to be able to have that data point. But certainly as you look at multiples on companies that have gone through SPAC transactions, you're seeing increase in multiples. Now that could be part based off of the composition of companies that are being put into transactions and having earlier stage companies that are driving up some of that multiple. There's certainly the interpretation that there's favorable valuations going through SPAC transactions currently.
We've just been talking about the SPAC itself and why it's an attractive exit. If we shift gears a bit, why would investing in a SPAC be an attractive option for an investor?
Investing in a SPAC and seeding a SPAC is probably attractive to an investor because there's typically a warrant that is attached to the share at the date of IPO. Most SPACs price their shares at $10 a share. As an investor, if you can get in on the IPO, you put in $10, you get $10 more or less guaranteed because the $10 you've just seeded into the company goes into a trust account and is protected. And you can ask for it back if you don't like the deal that the SPAC sponsor brings you. And that's 100% secure and typically earns some level of de minimis interest. In addition to the guarantee of getting your money back if you don't like the deal put forth by the SPAC sponsor, there is a partial warrant attached to each share. And that warrant is a freebie to come into the SPAC IPO. Typically, 30 days after a SPAC debuts its IPO, you can detach the warrant from the actual share and you can hold them separately. And as a result, there's a little bit of an arbitrage play that comes in. If you just want to redeem your cash at the time a deal is put forth, you can take it back at no risk, and you can hold the warrant, and the warrant's intrinsic value and time value of money is worth something, and you have upside. So there's no downside almost. The other thing is, if I'm buying in at $10 as an investor, and the deal is announced and the stock goes to 14 or 15, I can decide, do I want to roll my equity into the newly merged company, or do I want to redeem at $10 a share, which really doesn't make sense if the stock's trading at 14, and you can just kind of sell the shares and exit with a gain. The motivations are different. I would say there are other motivations of investors who put money in with certain serial SPAC sponsors, PE firms seeding SPACs, etc., knowing that reputationally the SPAC sponsors can bring deals to market that they would have never had access to as a common investor. And as a result, they're getting in at the ground floor of an exciting new company that's going to make its debut as a publicly traded company through a SPAC merger. These are some of the drivers that attract investors into SPAC IPOs.
You've touched on something that I'd like to kind of pull the thread on. You mentioned that we're starting to see how leading private equity firms are now registering their own SPACs. And we're starting to see this to be a growing trend. Do you think that, I'm going to use my quotations here, that we can expect to see a SPAC fund sitting alongside a tech fund and a credit fund in the future world of private equity?
A large number of private equity houses already have their own SPACs that are seeded, and some of them are launching multiple SPACs month in, month out. I wouldn't say you have a fund that is going to hold SPACs, but I would look at it as every SPAC is regarded as a standalone fund that's going to go and effectuate a merger. In the traditional PE structure, you raise a fund of $1 billion, $2 billion, $5 billion, $10 billion, and there's multiple portfolio companies that will go into the investment fund. When it comes to SPACs, think about it as each SPAC will do one deal. And so if you wanted to do 3 or 4 deals, you'll launch 3 or 4 SPACs, and you will effectuate mergers on a one-to-one basis. And that's how you will transact as a PE house.
We talked about how the success of a SPAC relies on the ability to identify a really good target and negotiate a good deal. And those are all skills that private equity is known for. Do you think, though, that there's either a perceived or a real conflict of interest by having a PE sponsor a SPAC? Effectively, the acquisition targets for a SPAC are largely the same as the acquisition targets for their PE funds.
It's 2 different investment philosophies. The type of investment philosophy of buying 10, 15, 20, 30% of a company is very different than what you see in your typical PE investment fund. Furthermore, PE buyers are typically value buyers. You go out, look at companies, get it at an attractive price, turn it around, and strategically exit down the line. When you're investing in a SPAC or launching a SPAC, you're taking that company public in a short period of time once it's identified, and you're carrying equity that's liquid, that's subject to a certain lockup period. Those lockup periods vary in time frame from 6 months to 12 months, or if certain thresholds are met. But then you're holding a liquid stock that you can dispose of in the open market at the appropriate time. So 2 different investment strategies, 2 different investment approaches. Could there be a perceived conflict? There's always perceived conflicts, but there's ways to work through them. And in this instance, it's actually a different way of investing money.
Thinking of SPACs, a liquid investment, a short turnaround, and a minority stake versus a fund, which is all about value creation, longer term holding as compared to a SPAC, and not necessarily immediately liquid. There's been a lot of, I guess, controversies, one way of putting it, in the market recently, and there's been signs of potential additional regulatory scrutiny around investors and the stock market in general. Do you think it's inevitable that given the sharp rise of popularity of SPACs that the mechanism can also be expected to be scrutinized by the SEC?
The SEC actually, I believe, tried to get ahead of some of the issues with SPACs by issuing some disclosure guidance, really in terms of making sure that they were informing potential investors. And so they were thinking ahead and adding in some additional regulatory measures so that public is protected to a certain extent. I'd say with any type of newer vehicle, you're going to end up having constantly evolving views. And so naturally, you're going to have potential for new regulation in SPACs and in all type of capital market transactions as things become more popular and as people see different sides of a vehicle.
I'm going to ask each of you to share with me, how do you think SPACs are going to evolve?
The ingenuity in engineering different aspects of SPAC mergers will continue to evolve. The product and how it's being utilized has shifted quite dramatically over the course of not only the last 3 or 6 months, 9 months, 12 months. So expect to see more. I think aligning the economic interests of the SPAC sponsor and what is called the SPAC carry or the founder shares with the long-term good of the company is going to be more and more of a trend, with things like sales structures and the like coming prepackaged in the prospectus of the SPAC that's undertaking an IPO. I would also say that the malleability and the flexibility of engineering deals that I mentioned earlier in this podcast will continue to evolve and bring the best of what is possible to both parties that are merging, both the SPAC as well as the operating company.
Excellent. And Alex, any thoughts?
There's a couple of things that could potentially happen. I think you might see more of a rise in multi-entity deals. Most SPACs have a preference to acquire one entity. There's the possibility that more than one entity is going to be included within a SPAC. That adds to the complexity, but I think that that's likely to happen a bit more often. And then with the number of SPACs out there, certain operating companies are going to think about the possibility of carving out some of their assets, including them into a SPAC. And so I don't think that that's necessarily happening immediately. I think that there's some instances of that occurring, but I think that that will become a little bit more prevalent in the future.
Thank you. And I'm going to make my own prediction. I know neither of you have had much sleep in the last 6 months thanks to the crazy popularity of SPACs. So my prediction is I don't think you guys are going to get any sleep for the next year. I'm sorry to say. You guys have been doing a fantastic job. And as the SPACs continue in their rise in popularity, you guys will be front and center helping companies negotiate and engineer and finesse those mergers. So thank you very much for taking the time to be with us here today.
Likewise, thanks for having us.
Thank you, Winna.
Thanks for tuning in to the EY NextWave Private Equity Podcast. For more thought-leading perspectives and to get in touch with Winna Brown, visit ey.com/private equity. You can also follow us on Twitter at EY Private Equity. We'll see you on the next episode.